Hi, I'm here with Platinum Asset Management's founder and CEO, Kerr Neilson. Kerr, you've been a very successful investor over many years. What do you think the quintessential characteristics of a good investor are?
I think it is to control your emotions. Emotions are what destroy good decision making. So what we discover in dealing with the public is they love the easy slogan. It sounds plausible. People must always eat. So we can buy food companies with alacrity and certainty. What actually happens is there's one little difference, and that is the price you pay. So firstly, you've got to control your emotions, and when things are down, you want to say, well, surely everyone's on that trade, and now it's the time to think about the other side. And when things are very high and continue to look perfect, you should start reining your own emotions in. But the second question is, how do you think about the investment versus the idea? And most investors love the idea and forget price. And I've failed to convey this to people so often, because if I said to you, for example, go and buy a Porsche, you'd say, well, how much is my budget? And that would be the first question. You say, I could start with the bottom of the rung or something really exciting. But you'd ask about, what's my budget? They never, my experience is that private investor seldom talks about price. He thinks it's all about the idea. But if it's an idea that's fully priced, you're not going to make money. So those are the two things. The next thing, once you get serious, if you want to be a really engaged investor, is you have to understand what has made the company successful and why will those factors still be in place, or why will the conditions not change. And most of the time, again, when there's perfection, you're on the cusp of change. So all the time you're doing two things. You're checking yourself for availability bias, where you're responding to nearby information, and you're checking yourself for extrapolation. If you do all these things, and there are not many, there are 3 rules there: test yourself and avoid too much emotion. If you do that, it'll save you from making some really silly mistakes.
I've heard you say in the past that some of your best investments have been where you've done something different to the market. Is that hard to do?
It's very hard, because you get lonely. You know, when you're out there and you're saying, well, why am I the only fellow in step? And you can be, simply because most investors don't like the solitude. And they feel, well, I'm not a genius, someone else has probably thought of that. And indeed, you should start with that proposition and then work your way back. But a lot of the time, there's a discomfort about being out of step, and there's a discomfort about having to wait for the reward. And that waiting time, in our experience, if the reward is real, the waiting time concertinas, because it happens earlier, and the magnitude of the first move in the stock can be huge. So you think, oh, I can't afford to wait. In fact, what you find when it takes place, you can do 30–40% in a couple of months. And then it hovers for a while, and then if it's followed through, it goes higher.
Well, that's brilliant advice. Thank you so much.
Pleasure.